Good afternoon, everybody. Hope everybody's doing well. If you're on the West Coast there, it might be the morning, so good morning to everybody if you're over there. My name is Randy Jones. I'm the head of Originations here at Applepie Capital. Today's topic, we're going to be talking about refinancing or recapping your franchise. Want to give you some statistics of the attendees here in the webinar. We have 23 brands represented, and approximately 33% of you on the line have 3 units or more, and 67% have 1 to 3 units, and a small number of people here are just getting started. Want to do a couple housekeeping items here before we get started. There is an attendee chat feature in the bottom left-hand corner of your computer screen. If you have any questions throughout the discussion here today, please feel free to put the chat in. We will try to answer them as they come up. We also did receive many questions pre-webinar that we're going to incorporate into the content here today. So go ahead and put the chat feature, the questions in the chat feature, and I'll address them as we go. So today we're going to cover, the topics we're going to cover are the pros and cons of refinancing your business, how a recapitalization can help you grow, what qualifications are lenders looking for, what questions you should ask your lender as you're going through the the refi recap process, and how to evaluate your options based on your growth plans. There it is. All right, so what I'd like to start with today is what's the definition and what is the difference between a refinance, a recapitalization, or a dividend recapitalization. Sometimes people think recap and refinance are synonymous. They're actually different. And so a refinance is simply just taking your existing debt and refinancing it into another loan without increasing the amount of outstanding debt. A recapitalization is utilizing a refinance, but then also increasing your loan amount by adding more debt to be used for corporate purposes, meaning remodels, expansions, working capital, etc. A dividend recapitalization is really, in essence, cash out. So you're going to do a refinance of your current debt, then you get cash out to be put into your business checking account to be used for dividend recaps, etc., for shareholders. So kind of moving on to that, or from that, what are the benefits of refinancing? There's multiple here. And I'm not going to read this to you word for word, but it's semi-self-explanatory. So really what you'd like to do, most people come to us with the desire to refinance when they're looking for better terms of the loan. The better terms may or may not be an interest rate. So given today's interest rate environment, over the last 6 or 7, 8 years, interest rates have been historically low. Rates are increasing now. So if you're in a fixed rate product that you had a while back, it may not make sense to refinance solely for interest rate purposes. However, if you're in a variable rate product right now, it makes sense to entertain doing a refinance to lock the interest rate into a fixed rate product. Some other terms to consider, better terms to consider, may be the amortization. If you're on a short-term loan now and the monthly payment is higher, it may make more sense to get into a little longer amortization to reduce the monthly payment. So when we're referencing better terms, we're really not just discussing interest rate. There's a lot of different factors that play into that. If some of you have an SBA loan, you may have pledged personal assets as collateral. You can refinance into a non-SBA product to release those personal assets. For example, you may have a house pledged securities pledged, etc., and the business is more mature now, doesn't necessarily need SBA financing, a conventional lending product could be a good avenue to release those assets as collateral. The other reason to look at a refinance is part of a growth strategy, is to free up SBA eligibility. The SBA currently has a cap of $5 million. And there's a big misnomer out there that you can only do one SBA loan. That is only accurate if you have one $5 million SBA loan. You could do 10 $500,000 SBA loans. So what a good strategy many times is if SBA is a good product for the brand that you're in, if it's a real estate transaction or something that you're looking at, SBA product is pretty attractive for real estate purchases, but you're going to be exceeding the cap. You could utilize a conventional loan to refinance your current SBA debt and then free up money to be used for future SBA borrowing. We discussed the interest rate risk in fixing your rate. The last portion here is as you can imagine, in doing this for 20 years, we've seen a lot of different debt schedules and balance sheets, et cetera. So the one thing to help clean up a lot of different debt is just to do one big refinance loan to simplify your life, quite frankly, and potentially your bookkeeper's life or your accountant's life. I just got a question here, asked if he could get a copy of this. Yes, Daphne, we will be emailing out a copy of the presentation. So, refinancing pitfalls, some things that you have to be concerned about. Why wouldn't you refinance? There's a lot of benefits to it, but there's also things you need to consider. Potentially loan covenants is a big factor here. So in the example that I referenced where you had somebody that refinanced 20 loans, so they went from 20 small loans that probably didn't have any loan covenants to one large loan of $5 million. And so once you start to get a loan that has $5 million, then lenders start putting some protections for them into it. And so some covenants that could happen would be a debt service coverage covenant or a post-distribution coverage ratios, et cetera. So just be cautious that you're not putting yourself into a loan product that potentially right after you've completed that refinance, you're pushing close to a loan covenant. Prepayment penalties are a factor that you should consider. Many times lenders will put a prepayment penalty on these loans. If you have an SBA loan, they don't have prepayment penalties for the most part unless you've done a real estate transaction. But you'll want to assess the cost of refinancing a loan versus the benefit or cash savings that you'd be getting by refinancing. I will say this, we see some people get hesitant to refinance a loan when they're in a 2% prepayment penalty on a $500,000 remaining balance. So the cost is, it's not minimal, but it's still $10,000, but the savings that you get by fixing the interest rate in the long run many times outweigh the risk of or the expense of paying that prepayment penalty. So it just takes some analysis to assess whether it's right for you or not. Again, when referencing some franchisees who we've worked with that have had multiple entities and their previous loans were in separate entities, and so therefore the guarantor of those original loans was one entity. If you combine all of your debt into one large loan, then it's that every entity that you have would be a cross-corporate guarantor and a borrower on those loans. And it's not bad or good. It just depends on many times personal preference and risk analysis. Personal guarantees, I would say 99.9% of the loans come with personal guarantees. If you were fortunate enough to obtain a loan in the past without a personal guarantee, this probably would have been a long time ago. But it's likely that most of the loans today will have a personal guarantee. Prohibitions against future borrowing is something that again, as your loan amount increases, is when lenders start putting covenants into your loan, and they may put some restriction of a specific entity from borrowing future money. So I would always analyze loan documents and commitment letters to assess the ability of you to borrow money again if you're looking to expand or remodel, because those are two different scenarios that you may need to or want to borrow money for. So just make the assessment and review what you're signing up for. Some of the costs associated with a refinance are, if most of you guys have borrowed money in the past, probably it's very likely since you're on a refinance or recap webinar, you probably had to go to your landlord and have them sign something from the lender that allows lender access to the collateral. Some landlords do it very quickly. Other landlords take time to do it, and it becomes a negotiation. Most loans, if you went into a refinance, you would likely have to go back through that process to get the landlords to sign off on that document. Not really a cost other than time. Some landlords actually do charge money to do that. Most of them don't, but it's more of a time expense than it is a cash expense. Lastly here is if you've had a 5-year loan already and your lease is 10 years, so therefore you have, if you're looking to refinance today after 5 years into your franchise and you only have 5 years remaining, you may need to go back to the landlord to either include options, which might be built into your lease already, or extend the lease to match the term of the loan. And you also need to make sure, if you've been a franchisee for a long time, make sure the franchise agreements also match the term of the loan. Most franchisees have automatic renewals, or franchise agreements, have automatic renewals. Some of them don't, so just you need to assess that the lease, the loan, and the franchise agreement all line up with the amount of term left on them. So what's the benefit of a recapitalization? Number one is this expedites growth. So many of you have been in business for a few years. You have some equity that's built up into your business. By doing a recapitalization, you can tap into that equity to promote future growth. So you could utilize that for either a down payment on the next location, combining that with a new loan, or you can fund the entirety of the next location or locations using a development line of credit by tapping into the equity that's in your current locations. Some other uses of that could be to complete the remodel or refresh initiative that your brand may have. Some brands have every 10 years they require refresh or remodel. Most of them will go, most franchise concepts will go through some type of initiative, whether it's a software initiative like a point of sale system, or a construction, reconstruction or reimage in that manner, or even if it's just a slight refresh that you need to do, or an oven breaks down. There's a lot of different uses that a recap would be helpful for. And so my comment typically to people when you're going to borrow money at some point in time for whatever use it is, would be to assess, does it make sense to use the current equity to help fund whatever the future is, because that's usually the least expensive type of loan, because you're using existing cash flow to cover new debt. Last two pieces here are working capital and dividend funds to shareholders, or dividend recap. They're relatively similar, is why I'm lumping them together. One of the questions that we had on this is, well, we actually had a few questions kind of on this topic, but one of it is how much working capital is sufficient for your business, and ultimately I would say what's always safe to have in hand is probably relatively similar to what you'd look at personally. But if you were to look at 6 months worth of fixed expenses, that's kind of a rule of thumb that you would use that you'd use personally. It also is applicable to the business. And so carrying that safe amount of working capital in the business accounts is likely is prudent. The other component here that somebody asked is this kind of falls under either refinance or recapitalization. Sounds to me like this person had funded their business with personal loans, and they wanted to know if they were able to convert those personal loans into business debt. The answer is yes, you can, but it depends on the lender. Most SBA lenders have a hard time with that. Conventional lenders might do it. Our direct lending product would do it. So it depends on the lender. Sometimes they view it as taking cash off the table, but we would definitely do that. Typically what's required for that is some type of note, or it has to at least be recorded on your balance sheet of the business, and then also on the debt schedule of the business. So as long as those two things are true, it is okay to do that. The next question, or I did have a question here pop up on the chat. It says, is a refi/recap loan faster and easier to get than a new location loan? So the answer to that question is yes, but again, it depends on the lender. So if you're using a lender that is going to utilize your current operations and provide you with cash, then yeah, that loan could close without the items necessary for a new location loan. So the difference is let's say you have 2 locations open and they're generating enough cash flow to support the new store. Then the loan would be provided to the entities for the first 2 locations and put into the business checking account for that to be used towards the opening of the next location. Whereas a loan just for the new location requires a lot of different things that you're probably used to, like a lease, construction estimates, permits, etc., and equipment invoices. So yes, the recap refi loan is much faster and much easier than trying to get a loan for the new location. Thanks for the question there. So recapitalization pitfalls, this is all similar to what we have already discussed. So that the same pitfalls apply to recapitalization versus refinances. I'm not going to go through these again, but I just wanted to point out they have similar pitfalls. So what are lenders looking for either a refi or a recap? So number one, 99.9% of franchise lending is cash flow-based lending, not collateral-based lending. In other words, a pizza oven isn't worth much, but the cash flow is worth a lot. And so that's the analysis. They're looking more at the cash flow than they are at the collateral. So the debt service coverage ratio that they're looking for is 1.25 times debt service coverage. So what that means is if you have $100,000 worth of annual loan payments, they want to see $125,000 or greater of cash flow available to make those payments. The tricky part of this component is some lenders want to see that ratio pre-refinance, and some lenders are okay with doing it post-refinance. So knowing where to go is half the battle if you're a borderline on this. So in other words, if your purpose of your refi is to improve cash flow, some lenders don't want to do the refi to improve your cash flow enough to meet debt service coverage. They want to see that you're already meeting debt service coverage, and other lenders understand why you're doing it. So it's a tricky component there. Number two is liquidity. I think I semi-addressed this question on how much working capital should I have in this business. So most lenders want to see that you're not all into the business. They want to see liquidity left over. It could be a combination of business and personal liquidity, but they do want to see, even if it's a refi with decent cash flow, they want to see at least 3 months worth of expenses in your business or personal checking account as liquidity backup. So clean books and records, and I'm specifically talking about this in a refi situation, because if you did loan one and it was on an SBA loan or other type of loan that you did projection-based financing and you didn't have business tax returns or profit and loss statements yet, you didn't have any questions on your books. Once you're operational and you have financial results and financial performance, it's really important to make sure those books and records are clean. The profit and loss statements should tie to the tax return, and you have to be careful of add backs and not treating your business like your personal checking account. It's always good to save tax, but if you're going to save on tax, do it with traditional add backs or tax benefits, specifically amortization, depreciation, and interest are all good add backs and tax advantages. But if you're running your dry cleaning, your cell phone, your car payment, and all of that through the business, those are challenging add backs. You might be making a lot of money, but if the lenders can't see that you're making that money, it's hard for them to get comfortable with the refi. Personal credit scores, over 700 is what we have here. There are a few people that would go down to 670 to 680. What's most important, or better said, what's equally as important in your credit score is your credit history. And so if you have a 700 credit score and you have habitual late payments on your personal credit report, that's actually more damaging than a 680 credit score with a rough time period in your life, where you can kind of prove that there were issues at a certain time period, and lenders will a lot of times forgive that if it's a borderline credit score. Point is be prepared to tell the story if you're in that marginal area. So the last point here, the next point, bullet point 5 here, is really what this is saying is the items that are reporting to your personal credit report, so the monthly payments and obligations on your personal credit report and the monthly obligations on your business balance sheet or debt schedule, you need to demonstrate that you have the income to support the personal and business obligations and have the income to match it. Depending on the industry, and probably specifically, I wouldn't say industry as a whole, but there are some brands that have seen downward trends. Subway, as an example, comes to mind. So the trends are important. Positive sales trends, ultimately, I would say anything with this is going to actually be a negative sales trend, but you're not going to get a red flag if your sales trends are down by 2% or 5%, and the expense trends or net profit percentage trend is still kind of remaining flat to slightly down, then you have a good chance of getting it done. But if you have year over year 5 to 10% declines in both sales and profitability, that's pretty hard to swallow as a lender unless you can show that the trend has stabilized. And once you can provide 6 months of stabilization, then lenders may get interested. But if you're seeing year over year decline in trend, it's going to be hard to refinance in that situation. Just had a question pop up that says, how important is it to have an income not from the business? Good question. So this varies. And unfortunately, I don't know your specific situation, so I'm going to answer it in a general way. If you're a smaller franchisee with 1 to 3 units open, income outside of the business is helpful. It's not completely necessary if the business can support both you and the business debt and have some buffer there, the 1.25 debt service coverage globally, then outside sources of income are not as important. If you're a 1 to 3 unit franchisee where everything's marginal, then outside sources of income would be something that would help push it over the edge. Once you're a 3 unit and above franchisee, outside income is a lot less important because there's more stores there that are help supporting the income, and there's more stability in theory within the organization. So what do you ask your lender? Number one is, can I take cash out of the business without tripping a covenant? So really what that means is that, again, as you step into larger dollar amount loans, you may or may not want to get into a loan with a covenant. One of the covenants that if you start to get a loan above 3 to 5 million, sometimes lenders will put in a post-distribution coverage ratio. So in other words, there's a debt service coverage ratio that just analyzes your cash flow available for loan payments. And then the next review is your cash flow after you've given yourself a distribution, how much money is available left for that loan payment. Many times that ratio has to be 1.1 to 1. So they want to see that you're not just squeaking by and draining the business of the cash. So many times a covenant would pop up in that scenario. Can I borrow money to do maintenance? Yes, absolutely. That is something that you need to assess. Again, the no additional indebtedness clauses that sometimes pop up, make sure that there's some freedom in there for you to be able to do the maintenance. Stuff happens. Ovens break. If you're in a service industry like Dog or Camp Bow Wow, we've done several transactions for Camp Bow Wows. Fencing needs to be repaired. Stuff happens. It pops up. Make sure you have the flexibility and freedom to be able to pay for those items. Next piece is similar to maintenance, but it's two different ways. One's can I borrow money, meaning from a loan. The other one is a lease. So the lease ultimately is a little different wording, but the same conversation applies. Just make sure that there are two different things, that there should be carve-outs available for you to borrow money with that. And then what if you want to open more units? Most of the time, I think the majority of franchise concepts now are looking for multi-unit operators. You want to be able to grow and make sure that your loan documents don't prevent you from that future growth. And so you want to make sure you're reviewing and assessing and asking the lender, do you have any restrictions on future growth for me? Question here is, do you have a minimum you consider for a loan? I think ultimately for a refinance, we would go down to $100,000. Our typical minimum is $250,000, but we just completed a refinance of $128,000. So refinances are yes, something that we would do. If it's new store development, then with the moving parts that have to happen there, it's a little tougher project. Then our minimum would be $250,000. So this is what should a capital markets partner do for you? So Applepie Capital is a capital markets partner. Our job and what a capital markets partner should do is understand your brand, understand your needs, and match the financing options that best fit based on the knowledge of the brand, but also your your desires. So ultimately, the capital markets partner should dive into your current situation, understand your future goals, and make sure the financing solution provided maps to your future goals. And the understanding of the brand itself should simplify the overall borrowing process, because you're not going to get questions about a brand. Those have already been addressed prior to you coming to us. There are various needs that brands have, whether it's a refresh, remodel, new store openings, and so a capital markets partner should have financing programs established for you based on whatever pops up within your brand or your situation. And again, I'll reemphasize this. Anybody that you're speaking with to help borrow money from, make sure they understand your long-term goals and the financing products offered map to that, and don't take away from that. What I see a lot of people doing in these situations is getting enamored with the lowest interest rate. And an interest rate, a loan with 5-year term or a 5-year loan is going to have a lower interest rate. And the mistake that I see people make is to take that loan at 5 years when a 7 to 10-year loan with a little bit higher interest rate is better suited for the cash flow. So don't fall in love with the rate, fall in love with the payment. You're all in business to bring money home to your family, to yourself. And so make sure there's an equal balance of cash flow available to live off of, and all your money's just not going to monthly payments. That gets old after a while. So how to evaluate your options for based on your growth objectives. The questions that you want to ask yourself is as you're kind of going through this, even if you're a large multi-unit operator, you still need to ask yourself, what do I want to be when I grow up? What's my financial capacity for my growth over the next 1 to 3 years? So financial capacity is really, in essence, how much liquid cash do you have, how much equity do you have in your business, and how much borrowing power do you have? And does that map to your goals over the next 3 years? And just assessing that in the beginning, knowing your goals and understanding your capacity helps you kind of plan for what you need to do or want to do in the future. This next question sounds similar, but it's a little bit different. The next question is, what's my operational capacity? So, in other words, smaller franchise operators, usually 1 to 3 units, many times they're the people that are in the stores working on a day-to-day basis. They're operating the location. As you expand and get bigger, your responsibility as an owner typically shifts and becomes you're overseeing multiple stores, and so you become more of a business owner as opposed to the operator. And I don't mean that condescending to the 1 to 3 units operators that are operating into the stores. The point of it is you're overseeing costs and the actually managing within the location. When you step outside of the location, that's a different skill set. And so you have to assess that. If I'm going to step out of the store and oversee the entire business, what management levels do you need to put into place in an effort to make sure the stores continue to operate as though you were there? And that's a mental mind shift that typically happens at 3 units or more. Is there territory near you to help you grow within the current brand? Many times I've seen operators that have built a very successful entity here. I'm in Michigan, and I'll reference our other location in San Francisco. I've seen operators in Michigan that wanted to go out to the West Coast. What challenges does that present to you as an oversight, and do you have the ability and the management teams in place for both locations? That's applicable to this discussion on the recapitalization product. Many times it's easier to tell the story on your first location, I'm sorry, I'm going to state that differently. It's tough to tell the story to a lender when you're going to go 3,000 miles apart and having a lender be the first one in to lend money to the new opportunity that's 3,000 miles away. A lot of times the good use of a recapitalization is to use those first, the entity here in Michigan to fund the first location in California, and then once you have operating results in California, then use the California entity. So just it's more strategy, it simplifies it, less discussions. As you're going through this, always have the end in mind. So begin with the end in mind. What's my succession and exit strategy? I did have a question here on how do I prepare myself for selling. And I would say there's two components to that. One of them is relevant to this discussion, meaning we're talking about debt, refinance, and recap. If your goal is to sell and you would like to get some cash out when you do sell, you do have to begin to assess the amount of debt that you currently have versus what's the value of your business. And if your goal is to sell in 3 years from now and you're semi-upside down with respect to the value of the business versus what's owed, then strategy likely would be to accelerate debt payments or keep the cash in hand, so that way when you do sell, you have the ability to pay down what potentially could be a loan balance that you have. Obviously, that's not an ideal scenario, but if the multiples in the direction of the brand or your units is down, then we see that sometimes. So just assess what's the value of your entity today, what's my debt expenditure potential, and have a strategy. If they're upside down, have a strategy on how to get out of that. Little different conversation that really doesn't have to do with debt is if you're going to sell on the succession plan, et cetera, at this point it becomes imperative that you do make sure your tax returns, profit and loss statements are as clean as possible. Remove any add backs. Typically 3 years is beneficial because you're going to maximize the multiple that your business will sell for. And if you're not familiar with what I mean by multiple, most franchise concepts sell for or trade for a multiple of EBITDA. And so that multiple ranges anywhere, depending on franchise concept, depending on direction of your specific entity or cash flow, they range anywhere between 3 to 6 to 7 times. 7 times is pretty high. 3 is pretty conservative. Somewhere in the middle, depending on your franchise concept, is probably where you fall. So why I suggest to you to have very good, clean books and records is, let's say you have, for easy numbers, let's say you have $100,000 of cash flow, and your records are messy, there's a lot of add backs. Ultimately, that means that usually when there's a lot of add backs, nobody's going to say I pass, but they're going to say, well, I'm only going to offer 2 or 3 times that $100,000. So you have $200,000 to $300,000 sale. Whereas if you have clean books and records and that sells for 4 to 5 times cash flow, then you're selling for $400,000 to $500,000. So the clean books and records netted you a significantly different cash in your pocket. And so saving on tax, et cetera, $5,000, $6,000 a year hurts you by a multiple of double. I mean, sometimes I've seen it be double the value. So just food for thought on that question specifically. So these next things are very similar, but they're just things to get your mind going. I'm going to read them to you. And these are things that lenders, as you're doing the recap product or refi product, to get a development line of credit. So these are applicable to doing a development line of credit. smaller franchisees, there's more questions on fast growth than there are for larger franchisees. So questions that you're going to want to be prepared to answer because your bank's going to ask you is what if I was able to buy units to double my size? So in other words, you're going to grow quickly. How are you going to prepare that or be prepared for that? What if you open 2 units within 2 weeks? Again, so you have a development line of credit, 2 possible locations come up. How are you going to handle the operations of 2 locations opening at the same time? Many times using a recapitalization loan to buy distressed units is probably the easiest route to go. So in other words, you're taking cash out of your current business to buy distressed units that are usually kicking up negative cash flow. But you want to just assess is okay, how much negative cash flow can my business absorb? And then as you're adding units, again, I think I addressed this earlier, but as you're adding units, make sure you have the management to oversee the operations. Adding units quickly, many times the result is less oversight on the operation. Just make sure you're paying attention to the good units as you're adding new locations. So this next chart, I've got about 4 minutes left, so I'm running right on time. This next chart, here at Applepie Capital, we have the ability to do all 3 of these loan products. Applepie Capital Core, or Applepie Core, is our direct lending option. We do have funding partners that do SBA financing and conventional financing as well. I'm not going to read through this each one line by line, but in the spirit of what the conversation today, the topic was refinance and recap. On a refinance, there has been some SBA noise beginning January of 2018. The SBA released a new standard operating procedure that made it more challenging to refinance any loan with an SBA loan. It used to be very hard to refinance an SBA loan with an SBA loan, but there's new verbiage in the standard operating procedure that makes it more challenging to use an SBA loan to refinance conventional debt. It's not impossible, but it's tricky. Applepie Capital Core loans and conventional loans are usually the better route to go, and for specifically if you're looking to lock the interest rate and you're looking to release personal collateral, these are your only 2 options. And the benefits to the core product versus conventional, or the access to core versus conventional, many times is brand dependent and the number of units open dependent. In other words, conventional lenders that specialize in franchise finance typically focus on larger franchisees, usually, depending on the brand, usually three units or more in 3 years' time in business. Our product steps in a little earlier than what a conventional lender would, and we do first unit financing for some brands. So we're not, the time in business and number of units open is not as important to us as what it would be for conventional lenders. So how do you get through the process? We have a short inquiry form that you fill out online, submit some financial information. We review and assess and come back to you with the various options, whether it's Applepie Core or conventional, potentially SBA. The next slide or step here, step 3, is choose your site. If you're only doing a refinance or a recap, then you skip that step. Then we go through and underwrite and provide decision and close/fund. I would say for this specific topic, again, refinance and recap, most of the time you can go from loan submission to closing anywhere between, again, if we're focusing on core or conventional, SBA is a different animal because they have to go through an eligibility check because of the use of funds to refi or recap, so that significantly increases the time. but for core or conventional, it's reasonable to assume if it's a pretty clean transaction that you could go from submission to closing within, I would say, 30 to 60 days in that time frame to allow for underwriting and closing. And we've had our fastest loan that we've ever done is in 14 days. So that'll give you some type of range there. All right, so this, okay, I got a question here. What if your current loan is with Applepie? Can you do a refinance to a lower rate, and what would the cost be? I would say we should take this offline. We can do a refinance. We actually do have a program right now available for our current franchisees or current borrowers. We do have a program available. We collect your financial results, and so therefore we kind of know where you stand. So I think if, I try not to say your name. If you could reach out to the person that did your first loan, we could assess it, or you could shoot us an email at the end of this, and I'll reach back out to you. So this next piece here is our calculator. We do have a calculator that you can go to our website to assess your current borrowing power to determine the ability to get funds for a recap. So you just go online here, and you're going to do a few inputs. You're going to input your EBITDA for the last 6 months. So again, I want to be specific to that for the last 6 months. What makes Applepie Capital unique comparatively to other lenders or traditional bank lenders is we're going to use 6 months of cash flow as opposed to the last year's tax return. So we're assessing the most recent, and that's beneficial to you, assuming the last 6 months were on a positive trend. So you input the last 6 months EBITDA, your current debt, and then it'll shoot out to you what your borrowing power is and what that loan would look like. So there'd be a refinance in this specific example, a refi of $300,000, and then it would show you that you're eligible for $600,000 additional funds, and then give you your new monthly payment range. So it's a great tool for you to do some self-digging, some self-assessment to see where you stand. And I'd encourage you to take advantage of that. That website is www.applepiecapital.com/grow. And so I encourage you to go there. And if there's no other questions that pop up, if I didn't address your question, I'll remain on the line here for the next 7 to 10 minutes. And just got one here. It says, I have a $250,000 HELOC. That is my only debt on my first business. I just bought a second unit, and I'm borrowing $30K from the seller for 2 years. Once I have that location all set up and I want to get a business loan and a line of credit replace my HELOC. I want to get a business loan and a line of credit to replace my HELOC. I'm also looking to buy or lease about $150,000 of new equipment in next year. Do you do that kind of loan? Yes, that would take some structuring, but yeah, as long as the HELOC is recorded as a loan on your business balance sheet and on the business debt schedule, we could take a look at cleaning up the HELOC. If you don't know, stands for Home Equity Line of Credit. So yes, we could take care of that, and we just would want to make sure that it's set up properly on your financial statements. And yeah, the new equipment, et cetera, are certainly things that we can help with. All right, I don't see any new questions on the chat, but I will remain on the line here if you have anything else. But a couple things as we finish up. If we have in the upper left-hand corner, you have the ability to give us a thumbs up or thumbs down to give us some feedback on the content of the material or my presentation. If you could take some time to go through those emojis there, that would be great. And if you have a general inquiry, you can go to loans@applepiecapital.com, and you can reach us at 1-800-720-0241. So I appreciate your time today, and we look forward to talking to you in the near future.
Randy.
Yep, so we just got another question here down here. It says, why go through rather than a conventional bank? A lot of different reasons. Our job is to assess your situation and put you into a product that fits you. And conventional lenders typically underwrite to one specific product. Our assessment is going to provide you financing that goes to with many options out there, but also competitively shop the project for you. So in other words, if you come to us, we'll review, we'll say, here's a strategy that works. Are you in agreement? And then we go and submit on your behalf. So that way you're not doing the work. So it's time savings and shopping for you, as well as assessing it to your specific situation, as opposed to underwriting to one product that most conventional lenders do. Sounds good, thanks. Comment back was great. I'll get in touch with you when I'm ready to make this happen. Thank you. We look forward to that. Oh, great. Okay, so just got another person came in here and said, Jeff Johnson. If you guys had worked with Jeff Johnson in the past, he actually went back to his old investment banking stuff. We do have new reps. If you worked with Jeff Johnson in the past, I would say I would reach out to loans@applepiecapital.com, send an email through that, and we'll assign the brand, the representative that now works with that brand. Okay, here's another one that came in. Great presentation. I have 2 stores currently, and I am 7 months into this, but not yet cash flow positive or break-even point. Can I consider Applepie Capital and lock a lower interest rate and take my home off the lien? This would take a little bit of assessment. We can do it depends on your business type. If it's a membership-based business where you're at, your last month is positive and it's a membership-based business, we could consider it. If you're not a membership-based business and your last 6 months don't yield cash flow positive yet, it might be a little too early. I would probably revisit it when you're at where the last 6 months are showing a cash flow or benefit. I will make a comment on that. Depends on on your analysis of cash flow. If you're looking at it from a debt service coverage, not cash flow, that's a different answer. If you have a shorter term loan and your debt service coverage is struggling because it's a shorter term loan, then we might be able to entertain it. But if it's a cash flow prior to loan payments, then we would have to assess on whether it's a membership-based business or we might need 6 months of positive history.